Welcome to the Deep Dive. We're your shortcut to understanding, well, the really important insights from today's business world. Today we're diving into Angi's Q2 2025 earnings call. And this wasn't just, another quarterly update. It felt pretty pivotal. The market certainly took notice, that's for sure. We're here to break down exactly what happened and why it matters to you.
That's right. Angi's management, they really laid out a very deliberate strategic shift. It's one they believe is going to redefine their path towards profitable growth. So our mission today is, well, to walk you through those headline numbers first, and then really peel back the layers, get into the narrative that's driving them.
Okay, let's jump straight in then. The financials. Angi reported GAAP diluted EPS of $0.23. Now, that actually missed FactSet estimates by about 0.03 cents.
A slight miss there.
But revenue came in strong at $278.2 million. That was a beat, about 6% against estimates, which were around, $262 million.
Exactly. A solid beat on revenue.
Yeah, although it is worth noting that's still a 12% year-over-year decline.
Right, that context is important. Revenue beat estimates, but still down from last year.
Okay, and adjusted EBITDA was $33.0 million. That's down from $42.2 million in Q2 2024.
So down year over year there, too.
But here's where it gets interesting. Operating income saw a really significant jump. It was up approximately 92% year over year to $17.7 million.
Wow, okay. So that immediately tells us there's a more complex story happening here than just looking at the top or bottom line in isolation. You've got an EPS miss, but then this strong revenue beat.
Right.
And this big jump in operating income, even while EBITDA is declining. It really highlights a company in transition, doesn't it?
Definitely.
To really get the picture, you have to look at those underlying strategic shifts. What's driving these numbers, not just the isolated results.
Okay, let's unpack exactly that, the strategic shift. Management's core theme, it sounded like, for the quarter was jobs done well. And this deliberate pivot towards, let's say, higher quality transactions.
Yes, that was the clear message.
Part of this involved rolling out something called homeowner choice. Now, they said this depressed network channel volumes initially, an expected consequence.
But it significantly boosted their proprietary demand. So it sounds like they're maybe intentionally trading some immediate volume for better quality down the line.
That's precisely it. And what really stands out here is that this isn't just, nice talk. The numbers actually back it up. Proprietary service requests were up 7% year over year.
Okay.
Proprietary leads climbed 16% year over year.
16%, wow.
And revenue per lead increased by 5%. This is actually the first time Angi has seen proprietary growth since, I think, 2021.
Since 2021, that's a big deal.
It's a massive inflection point. And management, they called this the strategic spine of their plan for profitable growth in 2026. It really signals a shift away from just chasing any volume towards getting these high-value transactions right.
That's a critical point, definitely. Management also made sure to highlight improved free cash flow, better than 2022 levels, back when it was actually negative. Right, turning that around is key.
And they talked about a disciplined approach to marketing ROI. They're targeting that return to profitable growth in 2026. The aim is mid-single-digit revenue growth.
Mid-single digits, okay.
With some modest margin expansion as that proprietary volume hopefully rebounds.
Right.
But, with such a big strategic pivot, how long do you think investors can realistically expect this initial volume depression in the network channel to last before the quality gains really start to pay off on the top line?
That is the million-dollar question, isn't it?
Yeah.
And management, well, they seem to be playing the long game here. They kept emphasizing this is a multi-year plan.
Okay.
So that current dip in network volumes, it's a direct result of them prioritizing homeowner choice and these better quality matches, which, inherently means less of that old spray and pray approach for the service pros.
Makes sense.
They're really banking on the compounding effect. Better pro engagement, higher conversion on the proprietary side.
Right.
That should eventually offset the network dip. That 2026 target for mid-single-digit growth, it suggests they think this transition will take maybe another 18 to 24 months to fully show up in the revenue numbers.
Got it. So 18, 24 months potentially. Okay, so how exactly are they achieving this quality improvement? It's not just a wish, right? The call mentioned, I think, 3 key product initiatives aimed at improving that match quality between homeowners and pros.
Exactly. It's not just policy, like you said. It's really about the tech and the product itself.
So first, they completely rebuilt their Q&A tech. They're using an LLM, a large language model.
The helper.
Right, the helper, they called it. This lets homeowners just describe what they need in their own words. which, should lead to much better task matching.
Less friction, better understanding.
Yeah, and they've already rolled this new Q&A out to about 15% of their volume, and they're seeing some pretty compelling results already, like 20% fewer wrong task credit requests.
Which basically means the pro saying, nope, this lead isn't right for me. So fewer of those is good.
Exactly. And also single-digit increases in pro engagement, higher rates, and win rates.
Okay, so early signs are positive.
Very positive. They expect to hit over 80% implementation by the end of this year, with more refinements coming in 2026, like an LLM Q&A right on the landing pages.
Okay, so that's the homeowner side. What about the pros?
Good question. Second initiative is on the pro side. They're increasing what they call match fidelity, basically allowing pros to pick the specific tasks and even the specific zip codes they want to serve.
Ah, more control for the service professional.
Right, which is a big difference from their old ads product.
Their pros just accepted these fixed baskets of leads, right? Which often meant lower engagement because the matches weren't always precise.
Yeah, I can see how that would happen.
So by moving these pros onto the main platform, all pros get this really precise control. The idea is better matches, higher conversion rates. It really empowers the pros to get the jobs they actually, want to do.
Yeah.
That makes a lot of sense. Give them the tools to succeed. And the third initiative.
Third, they're rolling out a new online enrollment process for pros. This is modeled on their apparently very successful European product.
Oh, yeah. How successful?
Well, they said it's acquired nearly 650,000 pros since just 2020.
Wow, okay. 650,000.
Yeah. It uses this one-by-one viewing interface. Pros can look at specific jobs and express interest. And in Europe, this approach led to a 50% higher success rate.
50% higher. That's significant.
It is. So they're naturally pretty optimistic this will drive significant volume and better matching here in the U.S. too. Could add thousands of pros per month, potentially.
Okay, those three are pretty concrete product changes.
Yeah.
Anything else supporting this shift?
Yes, actually. Platform consolidation. This sounds like a big behind-the-scenes efficiency driver.
Ah, the less glamorous but crucial stuff.
Exactly. Angie's moving from, believe it or not, 4 different tech platforms in the U.S.
Where?
down to just 2 by the end of this year. And the long-term vision is a single global platform.
That makes sense. Streamlining like that, it's just crucial for operating efficiency, right? And getting new features out faster.
Reduces overhead, too, I imagine.
Yeah, it's really a foundational move. You need that solid base to support all these other initiatives effectively.
Right. Okay, let's pivot a bit. Marketing spend. Consumer marketing expense was actually up.
Oh, interesting. Despite the focus on profitability.
Yeah, but Angi explained this. It's a strategic mix shift, they said, into their paid proprietary channels.
Ah, okay. Investing where the quality focuses.
Exactly. And their approach to ROI, it isn't about hitting some specific margin percentage on marketing. It's based on acquiring volumes out to what they call incremental break-even.
On a fully loaded LTV basis.
Right, lifetime value. The goal is maximizing the total aggregate profit, not just the margin on each acquisition. It's a subtle but important difference in philosophy.
It is. And speaking of LTV, another really crucial metric they shared was the LTV to CAC ratio for pro acquisition.
Lifetime value to customer acquisition cost, yeah. How's that looking?
It increased significantly. It's up to 2.8 times this past quarter.
2.8. Okay, that shows much better efficiency.
Huge improvement. Think about this. They acquired 39% fewer pros in Q2 compared to last year.
39% fewer.
But the total aggregate pro lifetime value they sold was only down 4% year over year.
Wow. So way fewer pros acquired, but nearly the same total value.
Exactly. It strongly indicates they're acquiring much higher value professionals now, which, lines up perfectly with this whole quality over quantity strategy.
That's a really strong indicator they're getting more bang for their buck, as they say. And looking ahead, Angi actually plans to increase its TV spend by 50% to 100% directionally next year.
Big jump in TV.
Yeah, alongside continued efforts in paid social influencer collaborations, things like that. They mentioned some success with these house calls videos. One apparently got over 25 million views.
25 million, okay, that's reach.
But, how directly does something like a viral video or increased TV spend translate back to that ROI for their pros and that ultimate goal of profitable growth?
Well, that's exactly what they're trying to measure with that LTV to CAC ratio we just talked about. The theory is, right, that higher reach, even from brand-building channels like TV and social, should ultimately drive more high-quality proprietary leads for their service professionals.
Okay, so the brand building fuels the proprietary engine.
Precisely. If the pros are getting better jobs, better matches, converting at higher rates, their lifetime value goes up.
Mm,
And that allows Angi to spend more efficiently overall to acquire both the homeowners and those valuable pros. It's all ideally interconnected.
a virtuous cycle, if it works.
That's the plan. And related to the pros, in terms of capacity and general industry trends, management said they don't really see pro supply as a definitive blocker for their future growth.
Interesting. You always hear about labor shortages.
Right, but they believe they're currently under-indexed on what they call higher capacity pros. Think firms with maybe 10, 20 employees.
Ah, so not just single operators.
Exactly. And they feel there's ample room to grow within the, let's face it, incredibly fragmented home services market.
Still very fragmented, yeah.
They did acknowledge some macro pressures back in April,
Okay.
but they noted things recovered in June and July. And they also highlighted the counter-cyclical resilience of their business. Apparently, about 2/3 of the tasks on their platform are non-discretionary. Repairs, essential maintenance.
Things you have to do regardless of the economy.
Right, which provides a pretty strong anchor, in potentially uncertain economic times.
Okay, that makes sense. So putting this all together, what does this mean for you, the listener, the potential investor? The market's initial reaction, as we mentioned, was quite positive. Shares were up over 15% pre-market.
Yeah, big jump.
And they held on to that momentum the day after the announcement. So that clearly signals that investors liked something. They seem to be rewarding that top-line beat, yes, but maybe more importantly, that inflection point in proprietary volume growth.
It does raise that key question, though. Why such a positive reaction when EPS missed and EBITDA was down?
Good point.
And I think it ties directly into that bigger corporate action picture. IAC planning to spin off its Angi stake.
Right, making Angi fully independent.
Exactly. It feels like the market is looking past these short-term investments, the costs of this pivot, and instead they're celebrating the strategic shift itself, moving towards a more sustainable, quality-driven growth model.
And the analysts seem to agree somewhat.
Well, you saw UBS and RBC either initiating or reaffirming targets. $22 from UBS, $20 from RBC. So there's some cautious optimism reflected there.
It really does feel like a reset of expectations, doesn't it? Moving away from that maybe growth at all costs mentality of the past.
Definitely a different tone.
To a clear focus on profitable, high-quality transactions. That path to mid-single-digit growth and modest margin expansion by 2026, it's measured, maybe not explosive.
It's a measure.
But it seems like one that management is clearly executing on step by step based on what they describe.
Piece by piece, yeah.
All right. Now for the part of the show where we get maybe a little speculative, just for fun, purely entertainment, absolutely not financial advice.
Definitely not financial advice. Got the disclaimer in.
But if we were pitching an outrageous but plausible trade idea to an investment committee based on everything we've just discussed, what could that look like?
Okay, let's brainstorm. Given Angi's very pronounced shift, right, towards these higher value proprietary leads and those improving LTV to CAC metrics we talked about.
The 2.8x?
Yeah. And the tech consolidation, aiming for that single efficient platform. You could maybe hypothesize a long-term quality consolidation play.
Okay, quality consolidation. Tell me more.
Well, imagine a long position in Angi itself. You're betting on their ability to use this better tech, this improved matching, to capture a growing share of the home services market, especially by tapping into those larger, higher capacity pros they feel they're under-indexed on.
Okay, long Angi. Makes sense based on their strategy. What's the outrageous but plausible twist?
The twist. You pair that long Angi position with a short position. Not on another big player necessarily, but on a basket of smaller, maybe regional, less technologically advanced home services aggregators.
Ah, the little guys.
Or even those traditional lead gen services that still rely heavily on, lower quality spray and pray methods.
Okay, so long the quality leader, short the laggards. What's the rationale?
The rationale is that Angi's intense focus on jobs done well, on delivering real ROI for its good pros, will eventually create a kind of unassailable moat. It could effectively starve out the less efficient competitors who just can't match the quality of the leads Angi provides or their unit economics, leading to Angi gaining market share and potentially even forcing industry consolidation, maybe on terms favorable to Angi as the winner.
Outrageous, but plausible. I see it. Betting on quality winning out and shaking up the fragmented market. Okay, interesting thought experiment. So there you have it, our deep dive into Angi's Q2 2025 earnings call. I think the key takeaway really is a company in the middle of a very Significant, very deliberate strategic pivot.
Absolutely. Prioritizing quality, prioritizing profitable growth over just sheer volume.
They seem to be executing on this multi-year plan. We're seeing tangible product improvements, operational changes, and those are already starting to show results, particularly in that proprietary growth figure and the increased value per pro.
Definitely signs of progress on the strategy.
Yeah.
But remember, everyone, this information we've discussed, it's purely for educational purposes. It should absolutely not be considered investment advice. Always, always do your own thorough research.
And consult with a qualified financial professional before making any investment decisions. Seriously.
Couldn't agree more.
Okay, so as we look to the future, let's leave you with a final, maybe provocative thought to mull over. Angi is aggressively integrating this LLM technology, the helper, into its homeowner Q&A, into its matching processes.
Yeah, that AI integration is key.
Could we be witnessing maybe the early stages of a real transformation here, where finding home services moves beyond just traditional search or simple marketplace listings and becomes more like a truly AI-powered concierge experience?
An AI concierge for home projects.
Yeah. And if so, how might that fundamentally alter the entire competitive landscape for finding and hiring pros?
That's a big question. What does that world look like?
We'll leave you to ponder that one. Thanks for joining us on the Deep Dive.